All right, let's talk about the head fake breakout here. And this is a trade that burned me today, and I want to go over it in detail so that you understand what it means when you're dealing with a stock that breaks down, but then ultimately does a head fake, meaning it reverses course on you and goes back the other direction. Perfect example of it today. So look at this S&P chart, SPY, and just get a feel for it. And I'm going to take away today's price action, so that's not influencing your outlook on the overall direction of the market. Yesterday, there was a pretty big sell-off. It engulfed the previous 2-day candle patterns, broke through the 20-day moving average, broke through the 10-day moving average. So I'm not totally sold that this market's going to break down and hit the 200-day moving average, but it's increasingly looking like it's going to. So you got to be on edge a little bit here. Then today, and I'm going to flip over to the 5-minute chart. So this is what the 5-minute chart looked as of the previous day's close. And then we open up lower. We have a gap to fill, but we don't fill it. We try to. We actually get into the gap a little bit, and it fails immediately. That's usually a pretty good sign that the market's going to continue selling off. And it does. And then it keeps breaking lower and lower, and then it settles in a little bit. We have an attempt at a breakout, but you can see this moving average of 20 periods provides some resistance, as it does throughout the most of the day. So it continues to move sideways, sideways, sideways. Okay, now I'm starting to realize that if we break down, we're probably going to do what we've seen in recent days, and in recent weeks actually, where we sell off 20 to 30 points more to the downside, and it kind of gets to become a 400 to 500 point down day on the Dow, 130 points down on the Nasdaq, and like 40 or 50 points on the S&P. And that trade has worked for me really good over the past few weeks. So we get it. We get the breakdown right here. It breaks through resistance. This 5-minute bar here, it starts to show, okay, we're making new lows. This is getting towards the second half of the trading session. I'm going to go ahead and buy SDS. Now, SDS is the inverse of the S&P by a 2-to-1 margin. So if the S&P 500 goes up 1%, it's going to go down 2%. And if the S&P goes down 1%, it's going to go up 2%. So I go ahead and use SDS. Now let's look at SDS doing the same thing, obviously, because it's going to mirror, 200% of what the S&P is doing in the opposite direction. So it's actually breaking out. I get in at 41.22. I'm hedging my 3 other positions, which is ETFC, WBA, and FLX. So those are all long positions that I have. And I'm going to protect those profits in them by getting long on SDS, which is going to benefit from the market going down. So far, it all looks fine, right? And I'm going to go back to the S&P now. Nothing much here. And then you start seeing the buildup. You start seeing this, okay, we're getting pretty serious here where the market's breaking out. It's back into the gap here. And that's when I decide, you know what? Probably going to have to get out of this trade. I get out at 40.84 and I take a 0.9% loss on it. But what a head fake, right? If you're looking at it from a pure breakout standpoint, you get the breakout and then minutes later, it's just coming right back down again. Now, it worked all throughout the month of April. I'm looking at my profits for April. SDS, I had a 2.4% profit. I had another 3.25% profit. I had a 1.3% loss. So overall, a pretty good solid net gain. And then in the month of March, similar results. I had a flat trade on SDS, but then I also had profits of 2%, 1.5%. So a consistent track record of making some decent day trade. And these were usually pretty short trades, whether they were a day trade or like a 1 to 2 day trade. So overall, I've been pleased with this. But right here, I mean, just because it's worked in the past doesn't mean it's going to work again in the future. And so this is a perfect example. You get the breakdown. S&P breaks down right here. You think, all right, it's going to start getting nasty here. And you have every reason to believe that it was going to get nasty. But then all of a sudden, the market just decides, you know what? Despite the fact that there hasn't been a lot of major rallies to the upside, we're just going to go ahead and rally right off those lows and keep pushing higher. Now, once I realize I'm wrong, I don't like to get more wrong. I don't like to stay wrong. So like I said, I closed my SDS trade for a 0.9% loss. I got long at 41.22, closed my position at 40.84, and had I not done that, you could see it just keeps going higher and higher into the end of the day. So I got out. I minimized my losses. Yeah, it's an irritating trade. I don't like the fact that happened to me today, but that is part of trading. And as long as you're a trader, that kind of stuff will happen. So, if you got sucked into the same thing, be easy on yourself. It's going to happen. As long as you're a trader, you're going to get caught in some bad situations. But how you manage the risk and how you get out of the trade when you know that you're wrong, that's what's going to make the huge difference in your portfolio at year's end, because you're not going to be staying wrong. You're going to be going ahead and admitting the fault on a trade and moving on to the next good trade.